Welcome back to this Moneycontrol live stream. You're watching Closing Bell with me, Nandita Khemka. Well, not turning out to be a good session for the market. Of course, it's the rupee weakness that has dented sentiment on the Lal Street. Yesterday, although it was a down day, we did good to recover from the day's low. In fact, and end above that 26,000 level. But today, of course, no such luck, given the fact that the currency has made a new all-time low of 91.05. Yes, that 91 level has been breached, and the currency, of course, has been in free fall ever since it breached that 89 level. Of course, we'll be getting Latha Venktesh in just a bit and understanding the real causes for such a dramatic slide on rupee, and where the trajectory is from here on, where what is the level to watch out for on the rupee going forward as well, and what's that one range that the rupee is expected to trade in for the next quarter or so. We will pose all these questions to Latha in just a bit. But taking stock of what's really transpiring in the equity markets, a triple-digit cut on the Nifty. In fact, it has broken below that crucial support level of 25,900 as well. So 25,865 is where it's at. It's a 160-point cut. Of course, as I mentioned, weakness in the currency market percolating, or percolating to the equity market as well. The midcap index down 0.7%, so it's across the board pain. Look at the breadth of the market, extremely poor. 1:2, that's the NSE advance decline ratio. 950 advances to 1969 declines. In terms of laggards, all the sectors are trading in the red. FMCG was trying to eke out some gains, but I think even that has succumbed to selling pressure. IT, real estate, these are some of the sectors that are leading losses. And of course, if you look at the list of laggards, it's a huge list. The list of gainers is pretty slim. Some consumer names feature on that list, but not a good day. And it is the FNO expiry day as well, weekly FNO expiry day. Usually we see last hour, seeing some wild swings, but today it has been a day of triple-digit cut, and that's what we are holding on to right now as well. But as promised, Latha Venktesh is here with us to talk about the rupee trajectory. It has been a very, very dramatic fall on the currency rate, right since it breached 89. 89 to 91 has been in a very short span of time, and that doesn't really happen very often with currency, right? Stocks, of course, it happens, but currency doesn't. So what is it that's led to such a dramatic fall from 89 to 90, and 90 to 91 as well has been quite quick?
Okay, well, it's a compounding thing, up until the fall really started on, as you say, mid-November, when the currency was at about 88.50. The October trade data deficit was very big at $41 billion. And from that day, we started seeing this slightly accelerated fall. And that's compounded. But the important point is it's not stopped even after good November data, which came yesterday. So we have to note that trade deficit is only one aspect that the rupee market looks at. The bigger thing is the capital flows that they look at, and there it is an unrelenting sell. And we see, when you see a big company like Prudential moving out, it is FDI, which has been there for 20 years or 15 years. And they are also seeing it profitable to sell because the shares are at elevated levels compared to their home country, and they are moving out. So it is this relentless selling that is the big factor for the fall in the currency. Now even debt has started selling. For the year as a whole, debt is still plus 8 billion. That is FPI debt. FPI equity is minus 17 billion. But in the last, from December 4th, we are seeing even debt. I mean, they want to save their whatever money they have left. So they are also selling out. So it is accelerated. And the last piece that has led to the acceleration are importers. They're usually prepared that 3% depreciation is there in the currency. But now, after November 15th, it is 6%. The last 3% has taken them by surprise. Probably most of them were prepared for 89.90. But when it went beyond that, there is now panic to buy up dollars for the remaining, near-term months at least. Even, sovereign wealth funds, none of them hedge because they are long-term investors. But when you see such a rapid fall, you feel maybe you want to hedge something. So everyone is in the market to buy dollars either forward or spot, which is exacerbating. That explains the acceleration. The continued fall is because FPIs are selling. The acceleration is because unexpected fall is leading to more people hedging.
Sure. So what's the range to watch out for? 91 to 92, that's what people are talking about.
Anybody who has tried to give a range has had egg on their face. Beginning of the year when I did the poll, people were expecting 87 to be, the weakest, because we were at 85 and a half on December 31st. So 87 looked pretty decent. It's dangerous to give a level, but in a panel that I just did, the average turned out to be 92.5 is where they see. And time-wise, the support is expected to come next quarter because usually the current account moves into surplus in the Jan-March quarter because everybody's exporting, like, to finish a deadline. And therefore, exports do very well in the fourth quarter. Again, there are naysayers. There are those who believe it's going to take 2 quarters for Indian shares to become attractive. Their argument being that we have to actually see earnings growth. Then the FPIs will come back. And the capital account bridges the current account deficit.
But how much of, the rupee's fall being arrested depends on the US-India trade deal? Because, everybody was talking about year-end and there's no deal in sight yet. And CA said perhaps March. So that also delays it by another 3 months. So
no, I'm sure it's a very good, feel-good news if and when it comes. But after the market's non-reaction to the positive November trade data, I'm beginning to worry whether trade is such a factor at all. For one thing, our exports have done superbly well. 20% higher year-on-year, 10% higher month-on-month. I mean, okay, to be precise, 19.5% higher year-on-year and about 11% higher month-on-month. After the tariffs came into force, exports are rising 10% month-on-month. Exports to the US year-to-date are 11% higher than last year. So it looks like the tariff barriers, we have been able to work around them. Either there are large areas which are excused, like electronics. Electronics has had its best month of exports in November. Or we have found alternative destinations like marine exports, where China has turned out to be an excellent destination. So the loss of the US markets has not impacted overall export growth. So if trade is not affected by tariffs, if the deal comes, logically it should not have
that kind of an impact.
But I would think it will have a sentimental effect. The real effect will come only when FPIs stop selling it first.
And then we'll talk about coming back. That's true. But, of course, you mentioned 92.5. Those are the kind of levels to watch out for. But do you think the RBI, of course, has said that it will not defend any level, but it will curb volatility? I mean, do you think that RBI will stick to that stance? Or if at all we see more depreciation coming in or more at the pace that we are seeing right now?
Well, see, even RBI is... they're not gods. They have access to more data than we have. But if they feel that the fall is speculative, then I guess they will come in. But exit of Hyundai and LG and Prudential is not speculative. They are people who have stayed in the country for decades. And are moving out because they think it's a good value. It's giving more value than their own home country. Why would the Reserve Bank come in the way? That would one reason, that you don't want to give foreigners a good exit. The second reason is, at the moment, the fall is not hurting the real economy. It is helping the real economy.
Because of...
It has helped exports.
Exporters,
I would think that the November trade deficit is lower than the October trade deficit primarily because of the rupee. Your exports got more competitive and you imported less because it was expensive to import. Probably some Gucci bags and whatever, certain things didn't come. Certain people cancelled their foreign trips. So it does reduce the deficit automatically when the currency gets cheaper. But therefore, I would think that RBI and the government will be worried if the real economy is hurt. At the moment, the real economy is being helped. We just have in the mind a phobia that when the rupee falls, it's bad news. It's not. It is only when it destabilizes the real economy, it is bad news. That, you have to raise interest rates to defend the currency, which we did in 2013. It's not at all come to that level.
So it's not alarming.
So RBI will not act. They will act. They have, weapons. They can say LRS we won't allow or something like that. They can come with capital controls. They can change tax policies, give tax benefits to FPIs. I mean, that will come from the government, of course. All those arrows are there. But at the moment, since real economy is being helped and only the financial stock markets are getting impacted, they are not intervening, is my sense. The moment they see real economy getting impacted in some way, I suppose that's when they release the arrows in their quiver.
Okay. Let's see how this unfolds, because of course, everybody was watching out for 91 to the handle,
No, the
and
speed
that has
is
also been
a little unsettling.
Unsettling, yeah, that's true. Thanks, Latha, for that. Explanation. Of course, always appreciate your joining in, and of course, if something dramatic happens again, we'll go and get you on board.
Thank you
the
for
show
having me.
Thanks a lot. Well then, moving on to the equity markets, of course, as I was mentioning, a triple-digit cut on the index. We'll touch base with our technical analysts as well and figure out what are the next levels to watch out for. Because, mind you, 25,900 was pegged as being a very crucial support for the Nifty. Now that has been broken. Does that mean we go towards 25,800, 25,750 on the downside? That's something we will be asking Osho Krishan, who will be joining in just a bit. But as I was mentioning, it's an across-the-board weakness. All the sectors are trading in the red, led by the likes of real estate and IT. IT, mind you, rupee fall is actually good for IT. The IT was gaining for the last 3 days, but they have snapped out of that gaining streak, and today they have joined the broader sell-off, and which is why we are seeing weakness across the IT basket as well. The midcap index, 0.8% kind of a cut there. Banking index, the Nifty bank index is also down. It's holding on to that 59,000 level on the downside, but once 59,000 breaks, I think that will be something that should be a cause of worry. But, in terms of other sectors, let's see which are some of the other sectors that are, really making an attempt to hold out. No, none of them. Across the board sell-off. FMCG, that's the least impacted, but nevertheless, it is in the red. Autos were the big laggards yesterday, and today they are continuing to, be in reverse gear, so to say. PSU banks down 1%. In terms of banks, I want to mention Axis Bank. There's been some concern in terms of margins. Axis management has told Citi that their margins may not bottom out in the third quarter as they had been expecting and as they had pointed out earlier. Instead, their margins will only bottom out in the fourth quarter of the current fiscal or the first quarter of FY27, and that has got the street really worried, and which is why shares of Axis Bank are taking a sharp knock, down 5% on Axis Bank. Eternal is the second big laggard. UBS has pointed out that Eternal has, ceded some market share to Swiggy in terms of their food delivery segment. I think that's that's one reason why shares of Eternal are down somewhere around 4.5%. But shares of Swiggy are also down 3.5%. Also, sources are suggesting that Zepto may be filing for its IPO pretty soon in December itself. And of course, that would be a cause of concern for the likes of Eternal and Swiggy. Perhaps that's why both the stocks, that's another reason that's contributing to the weakness when it comes to the new age stocks like Eternal and Swiggy. Aside of that, some metal names are taking it on the chin as well. Look at JSW Steel, Tata Steel, they are among the big laggards. HCL Tech is also among the big laggards, down 2%. Ultratech Cement, ONGC, Adani Enterprises, Hindalco, these are some of the counters that are under selling pressure. What's standing out? Titan is shining bright today. That stock is up 2%. Bharti Airtel doing well, up 1.5%. Other consumption names like Tata Consumer, Asian Paints are also up and about. In terms of some of the other movers, bucking the trend when it comes to IT is Tech Mahindra. That's among the gainers. Trent as well, on and off, it's basically oscillating between gains and losses, but Trent has been trying to, show some kind of mild rebound. The stock, of course, has been hammered out of shape this year. Perhaps it's the worst performing Nifty stock as well. Some kind of mild buying coming in when it comes to Trent. SBI Life as well, that's among the other gainer. But, I'm told, our technical expert is ready to join us. Osho Krishan of Angel One. Osho, great to chat with you this afternoon. Red is the color that's dominating the screen. Of course, it's Christmas time and we're all waiting for Christmas. But this is not the color we want to see on the screen. Deep in the red today, Nifty is now down almost 180 points. 25,850 also broken on the downside. 25,800 coming.
Very good afternoon, Nandita. Firstly, thank you for inviting me on the show. And definitely, green is the color that we in the market expect market to see every day. But unfortunately, market has been on the downside today. Overall, what we are witnessing on the daily time frame chart, that Nifty has formed lower highs formation in the daily time frame chart. Although the concerning factor will start once if it breaches the zone of 25,700. So that is still a very strong and crucial support levels for Nifty. So I'm expecting till those levels are intact, I'm expecting that any kind of correction should be seen as buying opportunity in the benchmark index. On the lower end, firstly, the first support was nearly 25,850, but as soon as of now, the index has already breached the support levels and has started moving towards the next support of 25,700, but that's on a positional point of view. So overall, one should not be very much aggressive now and wait for further correction towards 700 odd levels to start accumulating position. I'm expecting that bounce can be seen in the coming trading session. So overall, the scenario seems bit challenging, and one should be focusing on thematic movers rather than every movement in the benchmark or the key indices. Bank Nifty, on the other hand, is at a very crucial support levels. 58,800 has been a very strong support levels, and till the time it is having or maintaining its structure above 58,800, I'm expecting that bounce can be expected, but any breakdown below 58,800 can be seen as an opportunity to look for short positions in banking index. So overall, it's a challenging scenario, and one should be very much practical with their approach. With firm risk management will be advisable.
Okay, caution is the word going forward. Of course, there is been quite a bit of a weakness in the market, also attributable to the fall in the currency. But talking about the banking lot, Axis Bank today has taken it on the chin. Of course, the reason is pretty much obvious. They have said that the margin recovery will be C-shaped and will be shallow, and the margins may only bottom out either in the fourth quarter of FY26 or the first quarter of FY27. Stock is down 5%. Is there any kind of breakdown of any technical level after today's move, and how would you look at the stock on the charts? Which one would you prefer within the private banking lot? Because margin pressure will be there across the private sector banks because of the rate cut that the RBI handed out last time.
Yes, no doubt. Today, Axis Bank has dented the sentiments in the banking space, has corrected over 5% as of now, and the counter is looking quite weak because the development in the last 1 month, near about the same zone, near about 1200 zone, was kind of a low that we have witnessed in the month of November. And from there onwards, the counter have started gaining some positive traction. But again, after a brief consolidation zone, the counter have given a very strong breakdown, and I'm expecting that any breakdown below the zone of 1200 can further plunge the counter towards 1160, 1170 kind of targets. So at present levels, caution is maintained in Axis Bank. 1200 is a very strong support levels. As I mentioned, that November month had seen a very strong support levels, and from here onwards, the counter have started gaining traction. So 1200 will be a very strong support zone. If it breaches below 1200, then another 40 points of dip can be seen in Axis Bank in the coming future. So overall, the technical structure has been broken down towards the bearish outlook. But again, I will be waiting for one another day. If there will be a follow-up sell-off, then one can look for selling opportunity. Else, we can witness some kind of rebounds or some kind of rebound or resurgence in the coming period.
Okay. That's about Axis Bank. But, I want to talk about Vedanta as well. It has got the NCLT nod for its demerger plan, and this nod has come through after a long wait. The stock, of course, jumped to a 52-week high as well today. The stock has been doing well any which ways. Last 3 months, I think the stock has rallied in excess of 30%. The entire metal universe per se has been doing well, but particularly for Vedanta, after today's move and hitting fresh 52-week highs, are the chances of more upside from here, and what are the near-term targets?
See, overall, the technical, on the front of technicals, I am expecting the target of 575 to 580 to get tested in the short-term period. But as of now, only the counter has seen 572 odd levels. So overall, I'm expecting the bullish momentum will be there, but one should wait for some kind of cool off, because after the rally of nearly 4% in today's trading session and nearly 6% in the week, the counter is at a very strong momentum, but overall it is at a overbought terrain. So one should maintain a cautious stance. If someone is already holding position, it will be advisable to hold or trail the profits with a stop loss of 560. Again, 575 to 580 will be the short-term target or immediate-term target. If there will be any kind of correction post that, then one can look for buying opportunity on dips of 540. Overall, the sentiments remain positive. 540 to 580 is the immediate trading range that I'm expecting in Vedanta.
Okay, those are the levels to watch out for on a Vedanta. But FMCG has been trying to show some traction in the last couple of sessions. Tata Consumer, for one, has done well. Last two sessions at least, it has done fairly well. And within the FMCG pack, I think Tata Consumer is the one that has outperformed. Anything that you like in the staples basket, the likes of Tata Consumer, HUL, even Britannia, Marico, anything that is worth a look at the current juncture?
There are various counters which are looking very positive from the FMCG basket. First, Tata Consumer definitely has outperformed and it has maintained its higher highs kind of a pattern on a daily time frame chart. So I'm expecting that the positive momentum should be maintained in Tata Consumer. On the higher end, 1200 will be the first target, and if it breaches the zone of 1200, then another 30 points of rally can be seen. But the other counter which is giving a very strong momentum and it is kind of a reversal from the lower end is Godrej Consumers. Godrej Consumer have seen a strong correction from the zone of 1300 towards 1100, 1120 odd levels. And again, in last three trading sessions, the counter have started gaining positive traction and has surged above the short and medium term moving averages. So I'm expecting that from risk reward point of view, this counter looks more promising. It is having a expected target of nearly 1260 followed by 1280 from short to medium term point of view, while on the lower end 1140 is a support zone. So at current levels, this counter looks more lucrative and one can look for accumulation in Godrej Consumer.
Okay, look for accumulation in Godrej Consumer. I also want to talk about some of these insurance names, particularly PB Fintech. It's under severe pressure. The stock is down almost 6%. Of course, the insurance amendment bill has been tabled in the Lok Sabha. 4 o'clock is when it will come up for discussion. I think it mentions the fact that regulator is likely to cap commissions for insurance agents. And that happens, of course, it will be negative for PB Fintech, I think, which is why such a stark reaction in trade. But the stock has anyway been under pressure. After today's move, has there been a breakdown of any kind of crucial support level? And how should one trade here?
Technically, there is a kind of reversal from a very strong resistance zone for the counter. So I'm expecting that in the short term period, the counter can see some kind of further correction or cool off from the higher levels. The target comes around the zone of 1750 followed by 1740 on the lower end. So I'm expecting that in the coming period, there is a possibility of further correction. Nearly 60 to 70 points of correction can be seen in a short-term point of view. But overall, the trajectory remains on the bullish front and the zone of 1750, 1740 can be seen as buying opportunity. On the higher end, the zone of 1940, 1950 remains a sturdy hurdle, and a breakout above 1950, sustainable breakout above 1950 can provide very strong momentum in the coming period. So it will be advisable to start accumulating the share on dips of nearly 1750, 1740 kind of zone. And on the higher end, 1930 will be the first target. And if it breaks through in the coming future above 1950, then one can go aggressively long in this counter.
Okay, that's the view on PB Fintech. But let's take stock of some of the buzzers as well in trade. There were quite some buzzers in a down market as well. Exicom Tele, that stock saw a fourth straight day of gains. In fact, the stock is up somewhere around 18% in the last 4 sessions. From July 2024 high of 510, although the stock is down over 70%. Any thoughts, on how to approach this? Should one ride the momentum here?
Technically, the counter is reversing from lifetime low zone. So technical parameters are already very deep into oversold terrain. So today being the kind of first volume-based buying, I am expecting that if it continues on the higher end, the breakdown zone, nearly approximately around the zone of 125 to 126 is a very critical resistance level for the counter. If it breaches the zone of 126 on a decisive manner, then from there onwards we can see some kind of momentum in the coming future. But overall, the technical setup remains on the negative side, and some rebounds or some kind of pullback can be expected in the counter, but I am expecting 126 as the critical hurdle. A breakout above 126 can provide a momentum towards the zone of 155 to 160 in the coming days.
Okay, that's about Exicom Tele. Hold that thought, Osho. We're just looking at how the markets have shut shop for the day. We'll talk about more stocks in just a bit. But yes, with deep red, that's how we are ending the day. FNO expiry, it was the Nifty FNO expiry as well. But 25,850, thankfully we've held on to that level. But yes, that crucial support of 25,900 has been taken out in today's session. A 175-point cut on the Nifty, Sensex down over 550 points. Midcap index, deeper cuts there, it's down 1%. So once again, pain in the broader market continues. The breadth of the market firmly in favor of laggards, almost 2:4 rather, 2:5 actually on the, on the breadth front. 907 advances to 2,032 declines. So 2:5, that's the NSE advance decline ratio. Sectorally, all the sectors ended the day in the red. Deep cuts when it comes to real estate and IT. IT, of course, snapped out of a 3-day gaining streak. All the other sectors have also ended the day in the red. In terms of some of the frontline stocks that have not done well and that have led the losses from the front are the likes of Axis Bank, Eternal. We just told you what the news was, and of course, reacting to that negative news, Axis Bank in terms of margin is bottoming out, and Eternal in terms of market share, and also the fact that Zepto may file for IPO in December itself. Metal names, JSW Steel, Tata Steel, IT names, HCL Tech under pressure, Max Healthcare, Bajaj Finance, Hindalco, ONGC. The list of laggards is long this afternoon. Some consumption names held out, Titan, Tata Consumer, Asian Paints. These are some of the stocks from the consumption end that did well. Even Bharti Airtel, for that matter, has been trading in the positive zone right from the start. M&M, Tech Mahindra, Interglobe Aviation. Interglobe Aviation, by the way, I think is the 4th straight day of gains for this stock. Kotak Mahindra Bank from the banking lot, and even ICICI Bank held out. SBI Life also ended the day in the green. Just want to point out some of the movers from the broader end of the markets as well. On the Nifty 500, just want to see which are the top movers there. Kirloskar Oil, that stock was up 8%. Tata Tele up 6%. Triveni Engineering, that's also up somewhere around 5%. Leela Palaces, that's up 5%. LT Foods, Supreme Industries, Vedanta, of course, we spoke about it, up 4%. And in terms of the laggards, Ola Electric, that stock was down 8%. PB Fintech, we discussed that, down 6%. Transformers and rectifiers continues to be under pressure. That stock was down 5%. And, you have Aavas Financiers and e-clerks. These are some of the other laggards on the Nifty 500 index. Any thoughts on transformers and rectifiers? It has had its good days, but the moves on this stock happens to be quite dramatic. When it gains in double digit, and once it starts losing, it falls, for days at end. How are you approaching transformers and rectifiers?
Overall, I am expecting that with the kind of breakdown the counter has witnessed, but again, in the recent 5 to 10 trading session, the volume has already been surging in the counter. So I'm expecting that current levels seems bit positive to me, but overall the counter is still into a very strong bearish sentiment. So I will be advising to start accumulation, but in a staggered manner. Although, as you mentioned, that it is a very volatile counter, there has been very positive days and there has been drastically negative days for the counter. But looking at the technical setup, the counter has now signaled for a bottoming out, looking at the formation of in the terms of volumes, and also the technical parameters from the oversold terrain have started signaling positive developments. So I'm expecting that in the coming future there might be a possibility for some kind of revival in the counter. Not very much optimistic on the target levels, but near about technically 340 to 360 seems to be achievable in a short-term point of view. So one can look for accumulating this counter, but with a strict stop loss placed around 255.
Okay, that's the view on transformers and rectifiers. Talk about fact as well. It was a volume buzzer today, third straight day of gains. and it has gained 12% during the 3-day streak that it has seen. It has gained for 3 days and it has gained somewhere around 12% in those 3 days. Volumes today were the highest in 4 months. Any thoughts here? Fact? How would you approach it? Because if you look at 2025 so far, the stock is down 8%, and it will be the first negative year for the stock after 2019. How does one take into account this data point, and what does one do with the stock?
See, overall, in a very short-term point of a span, the counter is having a very strong resistance around the zone of 910 to 915. But that once it gets broken out and once it gets a decisive upside movement, then from there onwards, we can see a decisive move towards 1040, 1050 in the coming period. So short term, there might be some kind of challenges that this counter can see. But overall, on a broader term time frame, it is looking very positive. It is maintaining the higher ground. So I'm expecting that once it breakthroughs above 910, then from there onwards, one can look for accumulating this counter on the higher end. 1040, 50 will be the first target, and above that also I'm expecting 1100 to get retested. So overall, the counter seems positive to me. Technically, there has been a bounce from the oversold terrain, so there has been positive developments as well. So definitely one can look to start accumulating, but in a staggered manner. Breakout above 910 can be seen as an opportunity to aggressively accumulate the counter.
Okay, that's about fact. Osho, any recommendations for viewers before I thank you? Anything that's worth a look at the current juncture, given the kind of weakness that we are seeing in the market?
Yes, there are various counters which are looking very positive to me. The first one is Uno Minda. Well, in today's trading session, the counter have seen a decent volume traction and from a very strong support of 89-day exponential moving average. So one can look for accumulation in Uno Minda at current levels. 1255, 1257 is the closing price. So one can look for accumulation in Uno Minda. On the higher end, I'm expecting a target, short-term or immediate-term target around 1300, followed by 1330. While it will be advisable to keep a stop loss of 1220. The other counter which is looking positive is Coromandel. Coromandel being from the cash counter, it is looking very positive. It has been hovering above the 20-day EMA. So I'm expecting that in the coming future, the counter can see a very strong breakout. One can start accumulating at current levels. 23.15 or 23.14 is the closing price. So one can look for buying opportunity. 22.70 is the advisable stop loss. And on very short-term point of view, 23.80 followed by 2400 can be seen as a target in Coromandel.
Coromandel and Uno Minda, two recommendations coming in from Osho. Osho, with that, I would like to thank you for taking out time and joining us this afternoon. Hope to see the color green on the screens soon, because both colors are the colors of Christmas, right? Red and green. Till now, we've been seeing a lot of red, but hopefully, as we head into Christmas, that turns into green. That's what everybody is waiting for, really. Thanks a lot for joining in.
Thank you so much.
Okay, that was the technical setup and how to really approach the market going forward. But important thing to note is that there'll be one development that the market will be watching out for. Tomorrow is the SEBI board meet as well. The market regulator, of course, will consider and clear several key proposals that market will be keeping an eye out on. As per sources, the agenda is expected to include a comprehensive review of mutual fund regulations, stockbroker regulations, and the ICDR framework to improve ease of doing business and boost retail investor participation. The board may also discuss revamping the conflict of interest code for SEBI whole-time members and officials. Other proposals likely to be taken up include easing of dematerialization of old physical shares, allowing incentives in public debt issues, raising the threshold for high-value debt-listed entities, and expanding the scope of work for credit rating agencies. The board is also likely to consider amendments to address IPO lock-in issues and simplify disclosures. So yes, an important meeting. Of course, that is something that we will be watching out for. And of course, you will get all the details on moneycontrol.com. So stay tuned to our website as well for all the details on the SEBI board meet that takes place tomorrow. Of course, tomorrow, we will be, looking for what direction the markets really take, because today the global cues were also not that supportive We had the currency in a free fall, making a fresh record low, crossing that 91 handle. That weighed in on sentiment as well. So yes, lots of factors at play. And as I mentioned, it was the F&O expiry as well. So yes, a confluence of factors that led to the weakness, and the broader market pain also was pretty much visible today. But on that note, let me bring on board our next guest for today. Joining me is Kunal Shah, Associate Fund Manager at Carnelian Capital. Kunal, great chatting with you. Not a very great day, so to say. We've seen how the currency has behaved in a free fall. Equities also, taking a hit. Nifty taking a 150-point knock, and that after hitting a fresh record high pretty, in the recent past. But how are you, really navigating this leg of consolidation that we are seeing in the market? Is it time to, deploy right now, or is it time to stay on the sidelines and ride out this weakness that we are witnessing in the market? How does one approach?
Thank you, Nandita. Always a pleasure to speak to you. So I think, as discussed earlier, right, we are in a phase which is very similar to 2022 during the Russia-Ukraine wartime, right? Almost for a year, we kind of did nothing, and there were a host of challenges out back then as well. This time around, for the last 1 year or so, it's more or less a similar kind of situation, right? Right from liquidity crunch to elections, and then basically also the tariff-related scenario. But a lot of positives also have happened in the last 6 to 9 months, right? So for sure, considering all of the developments on the positive side that has happened, and it always boils down with a lag impact. It never happens like today any action has been taken and it will be there for us to see in the economy tomorrow, right? So obviously there is 2 quarter lag impact, which kind of takes for all the positive things to drill down in the economy. So this time around, it's not going to be very different. So, to your specific answer, it's for sure a time to build portfolio. And then we all saw what happened in 23-24. We believe similar kind of scenario will kind of play out starting March in 2026 and 2027.
Okay, that kind of a scenario where you look at building your portfolio. So, what you're saying is, looking back at 2025, we've underperformed emerging markets by a wide margin, but last 2-3 months, we've managed to outperform, if you look at just the last 2-3 months in isolation. So, going into 2026, is an outperformance guaranteed? I mean, nothing is guaranteed really, but would you work with the thesis that we will outperform next year, and perhaps we can even outshine the US market? Is that a possibility at all?
Yes, absolutely. Very high chances of doing that, because, as I said, that export related companies or sectors is something which probably there is still a little bit of uncertainty. But otherwise, on the domestic side, things are shaping up very well, which gives us confidence for the earnings upgrade season cycle to start from Q4 onwards. And then next year, we should see around 17 to 18% kind of growth in earnings to happen at an index level, and there will be a lot of companies which will kind of do much better than that. So for sure, looks like we should continue to outshine what we have done in the last 3 months to do in FY26 as well.
All right. Okay. That's fairly optimistic, and that's kind of music to the ears. But how are you looking at the currency fall, the way and the pace of fall? Of course, a lot is riding on the FII return to Indian markets. It's the FII selling that has been one of the key catalysts for the fall in the rupee as well. But since you said that once we start seeing double-digit growth in earnings, FIIs perhaps would come back. But how have you really looked at the themes surrounding the rupee? You said there is some concern when it comes to export-oriented themes, but with this fall in the rupee, there's a cushion for exporters emerging, right? So, is there any pocket within the export-oriented themes that you would look at to play this rupee theme?
Right. So 2 parts I would take this question. One is at the economy level, right? The only way in the current scenario where tariffs, etc., are being placed for Indian companies to be competitive, is to get help from the rupee. Yeah, right. And the momentum which has been started on account of China plus one, Euro exports picking up for India in the manufacturing sector, etc. This, I think, is more by design by the regulator. And more so because crude, which is a very important variable when it comes to when it comes to imports, this time around has been quite stable. And so is, the forex reserves that we have as well. And more so, the current account deficit also looks very reasonable. So by design, we can kind of accommodate rupee at where it is right now, which can then make us competitive in the exports market, and which can help us continue the momentum that we have built on China plus one or exports picking up from India, more so on the manufacturing side. So that's the take on the rupee. And having said that, importers obviously will face a little bit of difficulty in realigning the place where rupee is right now, and exporters in the short term will kind of benefit on account of rupee. But we have seen historically that companies or businesses don't make money big time, or only on account of foreign exchange differences. Eventually, that gets priced into in the services that you provide or in the goods that you provide. So this may be a quarter or two phenomena where exporters will kind of benefit on account of rupee, and importers will kind of get benefit. But eventually, this will kind of settle down. And FII flows, yes, obviously, rupee dollar index returns do take a hit. I mean, you do nothing, and every day you see, your portfolio getting impacted only on account of rupee moving. So it does cause a little bit of pressure. But having said that, our earnings have to kind of rebound, which we believe it will do in the next financial year, which will take care of the flows as well on the FIIs front.
Okay, you say that earnings, of course, will be back with the bang in the next financial year. But how does the second half look like when it comes to earnings?
Q3 again could be a tad better than the expectations, but to our mind, Q4 will be the time when the earnings upgrade cycle will start in, and it's only when earnings upgrade cycles start, right? Markets start discounting what's there in FY27 and FY28. So Q4 basically will be the time to our mind where all the actions that have been taken back home will start reflecting in the economy and then eventually in the numbers of the companies.
All right, Q4, fine. But let's talk about some themes as well, other themes, so to say, domestic ones. For banks, focus is back on margins. Of course, the RBI rate cut cycle resumed. This time around we saw RBI cutting rates, and obviously the jury is out there whether we'll see another rate cut in Feb or not. But Axis Bank has, of course, today said that margins may bottom out in the fourth quarter or the first quarter of FY27. Earlier, they had, of course, hinted that it would bottom out in the third quarter. So, margin concerns were anyway plaguing some of these private sector names. What does one do with private banks for the next 1 year?
I think private banks generally should do good. We are very bullish on the credit space, and our bullishness comes from 2, 3 reasons. One thing is, the loan growth momentum, which kind of slowed down a little bit in the last 1 year. With all the actions that the regulator has taken, kind of will see a massive improvement from here on. So double-digit loan growth basically should kind of really augur well for the banks. On top of that, whenever there is demand for loans, you can price up your loans a little bit tilted towards how you want it. Right, that in a way kind of helps manage your NIMs over a period of time. And more so important is the asset quality, right, which so far has not seen any stress across different baskets. If you leave out 1 or 2 pockets here and there, asset quality holds up very well. So, valuations being where they are, very reasonable, near to averages, or in some cases below averages, with the loan growth momentum picking up and NPAs not looking stressful, should kind of augur well for the next 1 year for private banks. We've already seen PSU banks rally quite a bit from the bottom. Private banks should also follow up soon.
Okay, another sector that's in focus is insurance. Of course, especially the insurance amendment bill has been tabled in the parliament as well, and that will increase FDI to 100% from 74%. What kind of an impact are you envisaging? Will it increase competition? What does it mean for the existing players? Will smaller players benefit more? How does one read into the promotion, basically the hike in FDI, and of course the other proposals that are there in the bill?
See, Nandita, insurance businesses are long gestation businesses. They cannot be created overnight. So even if FDI limits are extended from 74% to 100% in the short term, for sure, it will not have a very big impact on the businesses that the existing companies do. Also, in case of insurance, the top guys, top five, six guys control a very meaningful market share when it comes to the insurance business. So that will kind of continue, the way it is, at least for the next 3 to 5 years. Don't see any meaningful change happening over there. More than that, I think what is bothering the markets, is a whole host of changes other than the FDI. That is, whether composite licenses will be given, not given, commissions will be, tapped or not. So all those things basically is kind of keeping the pocket a little bit nervous. But eventually, we believe that whatever has been proposed, right, is more in the sense of making insurance accessible and affordable to everyone. So we'll wait for the finer prints. But generally, we have seen historically that whatever actions will taken will increase the opportunity size, which eventually will lead to good growth for the insurance companies.
Okay, all right. That's the view. But last couple of questions then. Kunal, EMS has been one theme that has been in the throes of correction. Just want to ask you, what do you feel? Is it just a valuation correction or a deeper reset is at play? How are you looking at this kind of correction that we have seen in some of these electronic manufacturing services companies?
So I think actually the kind of businesses that they are, the business opportunity is real. There is no question about that. But what had happened was there were excesses built in terms of valuation and the growth expectations, built in from these companies in the last few years, right? Which has kind of now, tapered off a little bit. But still, to my mind, we'll have to see actually whether there are earnings cut or no, because that will further determine derating or re-rating to happen from here on. So I believe, there are still more earning cuts to happen, particularly in few EMS companies, which will kind of lead to further derating to happen in those EMS stocks. At the end of the day, it's a matter of risk reward and what is kind of built into the expectations or not. Clearly, EMS pack lot of earnings growth was built into the price. And if at all there could be anything was disappointment, in earnings, or then probably you call it anything else.
Right. Okay, Kunal, before I let you go, what are the top 3 investment themes at Carnelian at the current juncture for 2026?
I think there are quite a few pockets, right? I think there are still capital goods is something. There's a lot of spending happening on the power side, right? There is good visibility of revenues out there for the next 2 3 years. Valuations are reasonable. So on the power side, there is reasonable opportunity. Auto and auto anchs, to our mind, continue to do good. And again, over there, reasonable valuation, reasonable visibility of earnings out there. CV cycle probably kind of picking up, could be looked into as well, where nothing has happened for the last 3 years. There are pockets of, other niche capital good companies as well, which kind of have decent visibility basis the order book that they have. Pharma and CDMO space, again, there are quite a few interesting opportunities out there where there is visibility of earnings, where there is decent valuations, and if earnings play out, probably re-rating as well. So I think there are pockets, where there is decent visibility of revenues and earnings, and at the same point of time, decent valuations for the earnings growth that they offer.
Okay, those are the themes. With that, Kunal, we'll have to cut short this interview. We are running out of time. Always a pleasure chatting with you, and I hope to interact once again before the end of the year and take stock of things. But thank you for taking out time and joining this afternoon.
Thank you. See you soon.
Thanks a lot. Well, that was Kunal Shah of Carnelian with his thoughts on the markets and the top 3 themes to invest in for the next year. But let's focus on some stocks that were the newsmakers today. Axis Bank Top Nifty loser down by 5%, not 4. Top Nifty laggard ended lower by about 5%. Of course, there is news flow. There was a Citi note on the bank as well. The bank has flagged off that there will be a delay in its NIM recovery. And in fact, the NIMs will now bottom out later than what they were previously guiding. It has revised its outlook. It has said that NIMs will now bottom out either in the fourth quarter of FY26 or the first quarter of FY27. Earlier guidance was that it will bottom by the third quarter of FY26. Now, management told Citi Research that margins are likely to follow a shallow C-shaped recovery path, with the NIMs targeted at 3.8% over the next 15 to 18 months from 3.7% in the second quarter of FY26. Now, Citi has maintained a neutral rating on the stock with a price target of 1285 rupees. The brokerage says that the corporate segment is gaining traction, while the retail business is also showing signs of recovery. Though sustained momentum will need to be closely monitored. Now, stress in the credit card portfolio is easing, personal loan growth is stabilizing, and there's no visible stress in export-oriented MSMEs as well. The brokerage added that slippages could see some seasonal uptick in the third quarter due to the agricultural cycle, though they are expected to be less severe than in the first quarter. Now, Citi also said that the optimization of the fee-to-asset ratio remains constrained in the near term. If you look at the stock, of course, today, it took it on the chin, but in the last, in fact, on a YTD basis, the stock is up somewhere around 15% or so. Another stock in focus is DMart, Avenue Supermarts. That stock was gaining in trade today. CLSA has reiterated its positive stance on the stock, maintaining that it's a high conviction outperform. In fact, Avenue Supermarts is among CLSA's top picks in the large cap consumer space. It has a target price of 6,300 rupees per share, which indicates an upside potential of 65% from yesterday's close price. Now, the brokerage says that DMart's expansion-led negative free cash flow is likely to reverse as store additions normalize. That's something that will mirror global peers like Walmart, Costco, etc. Looking at the free cash flow trends across these global retailers, CLSA said that early expansion years typically witness negative free cash flow due to rapid store additions. Now, as the expansion normalizes, the free cash flow turns positive, slowly, but it does. And DMart could follow a similar trajectory once its store additions stabilize. Now, CLSA expects FY25 to FY28 revenue CAGR of somewhere around 15 to 20%, driven by 155 to 225 new store openings. It is forecasting FY28 EPS at 30.2 rupees vis-a-vis 16.9 rupees in FY24, and PE multiple to ease from 227x to 127x. It has also added that India's consumption outlook remains strong and DMart has a deeply moated business model. DMart, in fact, recently opened a new store in Surat, Gujarat, and the new store commenced operations, marking another milestone in the company's ongoing retail expansion strategy. This opening brings Avenue Supermart's total store count to 442 across India. Well, so far in 2025, the stock has risen almost 10%. But yes, the free cash flow concern that one may have, the brokerage has said that, of course, that would reverse going forward. That's according to CLSA. Well, that was the day for you today. Not all that great, and much of it can be attributed to the free fall that we have seen on the currency rates. But on the headline index as well, we've broken below the 25,900 mark, finally settled at 25,860. Broader markets continue to wobble, another 1% cut there, and the breadth was firmly skewed in favor of laggards. 2:5, that was NSE Advance decline ratio, and portfolios, of course, severely hit today. But on that note, we are completely timed out on this edition of Closing Bell. We'll be back with the markets at 9 a.m. tomorrow. Let's see how things pan out. Today's weekly F&O expiry on the Nifty wasn't all that great, but let's see, tomorrow's another day if we can see some buying emerge at lower levels. From me and the entire team, thanks a lot for tuning in. Stay tuned to Moneycontrol for all your other news and updates, and I'll see you tomorrow.